Welcome to this MBKB session, a normal, ordinary run-of-the-mill payroll update until last week's budget arrived. So we can't call it a budget, but I'll explain that why in a minute. So what I need to tell you first of all is that I'm recording this session. So I will take questions at the end of each topic. You can either put your questions in the chat box or you can use Teams to raise your hand and then you can ask questions out loud. But we've also got general questions at the end of the session too. But just remember that you are being recorded. Just putting that out there before we start. So I'm Helen Hargreaves and I'm Head of Payroll Policy here at MBKB Training. It's been rather quiet over the summer with the government not making any significant decisions whilst they were electing the new Conservative Party leader and therefore our new Prime Minister. And so the country was crying out to hear anything about how the cost of living crisis would be addressed. Well, we should be careful what we wish for, shouldn't we? Because following the Chancellor's mini budget last Friday, we've got more information in our heads, though hopefully not in our payroll software, than we can cope with. This session today comes with a huge caveat, and that is that this is the position today. And by today, I mean this morning, because things might change by the end of the day, who knows. I'm going to talk through the huge changes that we've been told about over the last week or so. But a couple of days ago, the IMF, that's the International Monetary Fund, expressed grave concerns about the government's economic strategy. And then, of course, the Bank of England has intervened this week too. So with the furore that has followed, it might be that we see another change before the year is out, before the month is out, or even before the day is out. So this is the position as now. What you can know is that if we do get any significant changes, I will send out a newsletter. I'll send out an extraordinary newsletter if it's anything of a game changer. Otherwise, I'll make sure that in the next newsletter that will go out at the end of October, that you'll get caught up on what's happening with any changes that are coming there. So without any further ado, let's make a start. The agenda for today, we're going to look at the reason why you're all here, really, the mini budget, the Chancellor's fiscal event that he held last Friday. And then something that he mentioned in passing was the retained EU law that's going to be reviewed. So I'll explain what that means for you. Right to work checks will change as of tomorrow. Mileage expenses, which is one of the real killers at the moment, the cost of fuel. So what's going on with that? Real living wage, holiday payroll ruling, because I don't think a payroll update webinar would be a payroll update webinar without me explaining something about holiday pay ruling, and then we will take questions at the end, like I mentioned. So why are we calling it a mini budget or a fiscal statement or a fiscal event? The reason is that when a Chancellor delivers a budget, a proper budget, it must be accompanied by independent financial forecasts that are put together by the Office for Budget Responsibility. So instead of calling it a budget, in Chancellor Kwasi Kwarteng's speech last week, he delivered a fiscal event, meaning that we will have to wait until the real budget, which is on the 23rd of November, for those economic forecasts from the Office for Budget Responsibility, or the OBR. Unless, of course, something else happens before then, because now we know, we found out overnight that the Prime Minister and the Chancellor are meeting with the OBR today. So it might be that we hear something else before then, because it would seem that what all these economists want is to know what the economic forecasts are, what the plans are, what the thinking is behind it. And the idea is that if those forecasts say, actually, it's all right, calm down, don't worry, it's going to be fine, then everything will settle down. So we'll wait to see whether we get any of these forecasts today. Otherwise, there is a budget, a real budget involving the red box and the OBR financial forecast that is coming on the 23rd of November. That seems like a really, really long time away. But even though what we were told last Friday, whatever you want to call it, mini budget, fiscal event, fiscal statement, there were still a lot of significant changes announced, probably more than would get in a normal budget anyway. And we need to implement these changes really, really quickly. So what we thought we knew. The previous Chancellor, Rishi Sunak, thought that he was giving us some real certainty and stability last autumn when he told us that about the income tax rates and thresholds, along with national insurance information, so far ahead. So he told us last year that the following were frozen at 21-22 values for the next 5 years. So we knew the personal allowance was going to stay frozen at 12,570. We knew the higher rate threshold was frozen and the pensions lifetime allowance. We also knew that the apprentice levy offset allowance would be frozen for the next coming year, so the year that we're in now, and the apprentice levy percentage. We were told that national insurance rates would increase by 1.25% from April. The employment allowance would increase to £5,000 from April. And the basic rate of income tax would reduce to 19% in 2024. Then what we got told in March was that the NIC primary threshold was increased to 12,570, so it aligned with the income tax. So payroll had never known such stability, and to be honest, we should have known better. So already we got the change that came in March, announcing the change in the NI threshold from July, and that was only the start of it, wasn't it? So what has happened since then? Well, in the mini budget, I'm going to call it a mini budget. I'm not going to call it a fiscal event. We now have been told that all national insurance rates are going to reduce by 1.25%. So it's reversing that increase that came in April. That means that blended rates are going to apply for annual calculations. We know that there are going to be some income tax changes from April 2023. Off-payroll working rules are going to be reversed. Did any of you catch that one? And then we've got something new, an investment zones are going to be introduced across England. That's a definite, but the Chancellor is looking to work with the other home nations as well. And EU law, the retained EU law, is going to be reviewed. So we're now going to look at each of these in more detail, but remember, there's always the possibility of more change if the Chancellor ends up reconsidering his approach. So let's take these one by one. We know that all national insurance rates are going to reduce by 1.25% from the 6th of November. Although Class 1 national insurance is normally calculated on a pay period basis for both employees and employers, other types of national insurance are calculated on an annual basis. So directors' national insurance might be calculated on an annual basis, along with Class 1A national insurance on benefits in kind and Class 1B on pay-as-you-earn settlement agreements. So to ensure parity with those who pay national insurance each pay period, HMRC has announced an average or a blended rate, which should be applied to annual payments. Class 1A and Class 1B are both only payable by employers, and that rate is going to change, although the rate is going to depend on the reason it's paid and when. So employees who are in receipt of a termination or a sporting testimonial, they won't pay Class 1 national insurance on the payment that they receive. Instead, their employer will pay Class 1A national insurance in real time at the point that that payment is made. So in these instances, the rate payable will be the rate that's in force at the time. In simple terms, if the payment's made to the employee before the 6th of November, then the Class 1A rate will be 15.05%, and it will be 13.8% if the payment is made on or after the 6th of November. However, Class 1A national insurance paid by employers on benefits in kind, so that's paid in the July after the end of the tax year, and that's on all the benefits and expenses that have been received in the tax year that's just ended. So they will use this new blended rate, and that's 14.53% for employers. And that same blended rate is also going to apply for Class 1B. For directors' national insurance, there are two ways of calculating directors' national insurance. Those who use this annual method, they will use that blended rate of 14.53%. And for the directors themselves, if they're on a category A anyway, they will be paying 12.73%. There is another way of calculating directors' national insurance, and that's an alternative method. And in that method, directors' national insurance is worked out just like any other employees would be. So it's worked out at the time a payment is made, and if someone is using the alternative method, then they would just use the rate in force at that time. So either the 15.05% or 13.8%. There will be other blended rates for annual payments, depending on whether there is a different national insurance category in force at the time. But I've just given you the rates for the Class A. What you will need to do is you will need to check with your payroll software provider that they can get these rate changes in time, and then you will need to make sure that you can apply them in time, and that from any payments from the 6th of November onwards, because that's only 6 weeks away, that you are using the correct rate. If you don't, then it could well be that you'll have to process national insurance refunds to your employees. We've also got a payslip message that you've been told to put on the bottom of payslips that says that the 1.25% NIC uplift is to pay for health and social care. That no longer applies, so you need to take that off your payslips as well. And of course, we do know now that from next April, the health and social care levy is not going to be introduced. Right, so that was the changes to national insurance. I've just given you a summary there of the new rates that will be in force from the 6th of November. They don't include the blended rates for annual payments. So income tax changes from the next tax year. Here's a rundown. We know that the basic rate of income tax will reduce to 19% in 2023. So that's a year early. It was due to come down to that in 2024, but we've got that in a year early. And the additional rate of income tax, the 45% tax rate, is going to be scrapped in 2023. So that is going to impact the pensions tax relief, because at the moment, any contributions to your pension scheme attract tax relief, and you get tax relief at your marginal rate of income tax. So essentially, the highest rate of income tax that you pay, you get tax relief at that rate. So lowering the tax rate will also reduce the amount of tax relief that goes into your pension pot. So for basic rate taxpayers, lowering that income tax rate from 20% to 19%, well, good for us because we get it in our wallet so that we can spend it in the here and now. That's going to cut the effective pension saving bonus that you get from the government by around 25%. So it'll cut it from round about 25% that you get round about down to 23%. But the government has allowed a 1-year transitional period for those relief at source pension schemes, so that relief at source is when HMRC puts the money directly into your pension pot, and that will still be paid in at 20%. For additional rate taxpayers, reducing the income tax rate from 45% to 40%, their tax relief pot is going to drop from around 82% to 66%. So it is going to have quite an impact there. We're also going to be in a position where we will have a marked difference in taxation in Scotland to in the rest of the UK, because these tax reductions will apply in England, Wales and Northern Ireland. So everyone in those 3 countries, anyone earning over £50,270 will pay that higher rate of 40% on everything above that amount. But Scotland sets its own rates and thresholds, and people earning more than £150,000 in Scotland, which is where their top threshold comes in, they will pay tax at 46% rather than 40%, which is across the UK. And that cut in basic rate from 20p to 19% also won't apply in Scotland, because they apply their own rates and thresholds, and they already have a 19% threshold anyway. Now, something else that was introduced in the budget is something, we're not allowed to call it a budget, in the mini budget, was something called investment zones. And the Chancellor said that the government is looking to set up these investment zones in up to 38 local authority areas across England. And these sites will have generous, targeted but time limited tax cuts for businesses. There'll be more relaxed planning rules and that kind of thing. It's to encourage growth, it's to encourage investment in things like new shopping centres or apartments or offices and that kinds of things. So for businesses in these designated tax sites, now at the moment those sites have not been agreed. They're looking at bringing in up to 38 in various parts of England, but they're still in negotiations with the local authorities in those areas. But where they do come in, there'll be tax relief for structures and buildings, there'll be tax relief for investments in plant and machinery and that kind of thing. There will be no stamp duty to pay for where they're buying land to put on business premises and that kind of thing. So there'll be a lot of tax relief going on. There will also be employer national insurance relief for businesses in these investment zones that take on new employees. So again, it's like the free ports. They don't get the NI relief on existing employees, but any new employees they take on, then the employer won't pay any national insurance. That being said, the thresholds are slightly different. So it's expected that the threshold for investment zones will be the upper earnings level. So it'll be 50,270, as opposed to in a free part where the threshold is £25,000. So it would have been good if they'd have aligned the two thresholds. We might have a third category that we've got to start taking into account when we look at national insurance. So those are, we've done the national insurance changes, we've now done the income tax changes. What else did he mention? Well, we've got the off-payroll working rules that we're having the changes from 2017 and 2021 are going to be repealed. So workers providing their services via an intermediary are to regain sole responsibility for determining their employment status and paying the appropriate amount of tax and national insurance contributions under the IR35 rules. It's still a common misconception that IR35 came in 2017. It didn't. The off-payroll working rules came in the year 2000. But as successive governments didn't think that they were working properly, they made changes so that they, in 2017, the changes affected the public sector, and then in 2021, they went across to medium and large businesses in the private sector. The name IR35 is bizarre. We all call it IR35, and that's not the name of the legislation at all. IR35 is the number of the press release back in 1999 that actually said, right, well, we're going to start bringing some rules in for people who provide services by an intermediary. It was the 35th press release of 1999 issued by Inland Revenue. So IR, Inland Revenue, 35, because it's the 35th press release. There's no other legislation that I know of that's ever been known by its press release name. In fairness, I don't think we even know what the press release numbers are for anything else. But anyway, in 2017 and 2021, the reforms were supposed to overhaul the regulations and remove the idea that really people don't take any notice of the IR35 rules. So what the changes in 2017 and 2021 did were just change who was responsible for deciding if that worker should be treated as an employee for tax purposes. The underlying IR35 rules that came in the year 2000 never changed. The only thing that was different was that who had responsibility for determining that employment status for tax. Who was the one that said this is an employee, so pay-as-you-earn needs to be paid, or this one isn't, and we don't need to pay pay-as-you-earn. Until 2017, the worker was the person that was responsible for making that decision. But the government thought that it would be like turkeys voting for Christmas. They thought it would be better if the business receiving the service made that decision instead. So that's what happened in the public sector in 2017, and then it extended to the private sector in 2021. The repeal of the off-working rules, off-payroll working rules that we are expecting from next April does not abolish the IR35 rules. All it does is put us back to the same position, the same rules that were in from the year 2000. So the onus moves back to the worker, the person that is providing those services. It's them, once again, who decide, would I be considered an employee and should be paying pay-as-you-earn and national insurance, or am I not? And so am I responsible for paying my own? These rules come in from 6th of April 2023, but for services that are provided before the 6th of April, regardless of when payment is actually made. So someone could have done provided a service in March and the beginning of April 2023, but not submitted an invoice until May. it would still be under the previous, the rules that we've got now. So it would still be the business's responsibility to determine that status. Right, so that is everything so far on the mini budget. So before we move on to the next section, does anyone have any questions about anything that we've talked about in the mini budget? That's the national insurance, the income tax, the investment zones, or the off-payroll working. No questions? Right. We'll move on to the next section. We've got a general questions section at the end if anything strikes you. So, retained EU law to be reviewed. It's not the most scintillating title for a slide in a presentation, I'll grant you that. But please don't nip off to the loo or go make yourself another cup of coffee to keep yourself awake. It could have more impact on you than anything else I'm going to talk about today. Why? It was only one sentence in the Chancellor's statement last week, and his mention of sunsetting EU regulations by December 23 may have been overlooked by those who've just been focusing solely on tax cuts. It doesn't have the catchiest of titles, but the retained EU law revocation and reform bill, which was published on the 22nd of September, so it's published the day before, but the Chancellor referred to it in his statement, has the potential to impact everybody in the UK. So what did the Chancellor actually say? What he said was, to achieve a simpler system, and I'm quoting here, to achieve a simpler system, I will start by removing unnecessary costs for business. Firstly, we will automatically sunset EU regulations by December 2023, requiring departments to review, replace or repeal retained EU law. This will reduce burdens on business, improve growth and restore the primacy of UK legislation. You might be thinking, what on earth does that mean? And why does it have anything to do with me? Because Brexit was over and done with ages ago. We've got different problems now. Well, when we left the EU, legislation was passed which incorporated EU law into UK law. So all the rules that we stuck to because Europe told us to, and there were EU regulations, we did a blanket bill that said, okay, then we're just going to, all those EU laws are now going to become UK laws so that we carry on abiding by it and we stick to the same rules and regulations as the rest of Europe, even though we're not there anymore. This bill, the EU Law Revocation and Reform Bill, aims to overturn all that, allowing the government to make its own legislation. And let's be honest, that was one of the main drivers for people voting for Brexit. We want control of our own rules and we don't want to be told what to do by anybody else. But a lot of that retained legislation concerned employment rights. And there's concern in some quarters that that reduction of burdens on business to improve growth may lead to the removal or relaxation of some employment rights, such as 2-pay, paid annual leave, 48-hour working week, part-time and fixed term worker regulations, agency worker regulations. And it will go or could go beyond that as well, affecting us all, not just in a working capacity, but as an individual as well, to be honest. I was discussing this with a couple of employers the other day whose response to this news was, well, good, about time, because they mentioned that someone on maternity leave or sick leave continues to accrue holidays during their absence. And this right to accrue leave during either maternity or sick leave came about through cases ruled on by the European Court of Justice. There's no doubt that these regulations are a nightmare, or can be a nightmare, for businesses to administer. Some of the rules we struggle with most have come out of the European Court. Anyone who struggled to get their heads around the Alabaster ruling regarding maternity pay will really understand why some of these rules are just an absolute nightmare. And to be honest, I don't think even Ms. Alabaster asked for or expected what she actually got by the time that case had concluded. But on the other hand, some of the regulations that were brought in by the EU brought employment protections that we do all value, and we must just hope that a fair and common sense approach is taken to remove the elements that tie businesses up in knots, whilst also protecting those hard working rights that many of us might take for granted. So, are there any questions from you about the possible changes to employment law? No? Okie doke. Right to work checks now then. So, the right to work checks are changing from tomorrow. Every employer, no matter how big or small, needs to check that every individual they employ has the right to work in the UK. And this must be carried out before that person starts their employment, and failure to do so could bring a fine of up to £20,000 per employee, on top of the potential reputational damage if a company is found to be employing an illegal worker. So in the past, and by in the past, I'm talking pre-COVID. So in the past, checks had to be carried out in person. But when the COVID-19 pandemic hit, that was impossible because we could no longer meet face to face, could we? And employers could not carry out right to work checks in person. So the Home Office introduced temporary concessions that said that employers could carry out remote right to work checks. They could use video call to conduct the interviews, get scanned copies of the paperwork, the documents. And actually, the Home Office found that this was really successful, not just a measure for COVID, but actually something that they wanted to take forward beyond that. However, the various extensions and temporary concessions that we got are ending today. So from tomorrow, the Home Office has brought in these new rules that sort of try and take on a lot of the processes that we've been using for the last 2.5 years because of COVID. So from tomorrow, a right to work check must be conducted in one of three ways. So you can either go back to the old ways, performing an in-person manual check using those original documents, just like you did before. Or you can perform an online check using the Home Office online service, or you can engage the services of someone called an Identity Service Provider, or IDSP. So what's an IDSP? An IDSP is someone who can carry, or a company that can carry out the digital identity checks on behalf of an employer if they're not able to do it themselves. So legislation came in April that introduced these accredited identity service providers who can complete that identity verification right to work checks. That includes on British and Irish citizens as well as anybody else. They will do it for those who are out with the scope of the Home Office's online service. So if you're checking someone who can use the Home Office online service, fine. If you can't, then you now have the choice of engaging an IDSP. But what that does mean is that you would be paying a privately operated company, granted the Home Office approved, to conduct these checks remotely on your behalf. But there's a cost involved. Of course it is, they're a business. So it's expected that probably small or medium-sized employers won't necessarily conduct the checks in those ways using IDSPs, unless all their staff are remote and performing the in-person checks become just too difficult for them. It can't manage it. What you do need to know, though, is that anybody that has had a remote check during that pandemic period, so from spring 2020 through till today, you don't have to go back and retrospectively do it all again. If you went through that check under the processes that were in place at the time, then that's fine. It only applies from anyone moving forward. Does anyone have any questions about right to work checks? Mileage expenses. It feels in a way like the cost of fuel is now the least of our worries, but a month ago it was, all consuming really. So HMRC, over probably since the beginning of this year, HMRC has increased the advisory fuel rates each issue. The advisory fuel rates are reviewed every 3 months, and the latest ones were announced on the 1st of September, and they have increased yet again. I'm not going to read them out. You can see them on the slide. The previous rates you can use for up to 1 month from the date that these new rates apply. So essentially, you can carry on using these rates for the old rates for the rest of September, but then you must introduce these new rates. Advisory fuel rates are used by employers to either reimburse employees for business travel in company cars, or to reclaim back from employees the cost of private travel in company cars. The advisory electric rate for fully electric cars is 5p a mile, and hybrid cars are treated as either petrol or diesel for these purposes. So that's advisory fuel rates all going up and have gone up every 3 months since the beginning of this year. That's fine, we get that. But then let's look at the approved mileage allowance payments. So these are the payments that businesses can pay to employees who use their own car for business travel. And these rates have remained unchanged since 2011. Bearing in mind, we've had an increase every 3 months since the beginning of the tax year for the advisory fuel rates. These have stayed in place for 11 years. Now, earlier on in the summer, there were a lot of questions from MPs to the government to say, excuse me, do you not think that we should have these increased? Do you not think that with the amount that it's costing people to put fuel in the petrol tanks, if they are using their own car for business, then we should increase these rates? And there was answers that were given by the government that said, okay, yep, if the amount has been, if you can prove that they have actually spent the amount that they say they have, then yes, you can pay a higher amount. That was not true, and the government has had to come out and issue a correction to the guidance that it gave earlier on in the summer. So the tax and national exemption rules, if you pay above the AMAP rates on the screen, you can they are only tax and national insurance free if you pay these rates or under. If you pay above that, then they are subject to tax and national insurance. Any questions about AMAPs? The real living wage. The real living wage, or the voluntary living wage, is an independently set rate overseen by the Living Wage Foundation. And essentially what they do is look at how much things are going up, how much it actually costs to live in the UK, and then they set a national, a real living wage rate based on that. Usually the rates are announced at the start of Living Wage Week, which is in November. But this year they have brought it forward. And so they announced it earlier, and the rates came into effect on the 22nd of September. The rate applies to everyone over the age of 18, and employers are asked to implement that rate as soon as possible, but they have to do it within 6 months. It's important to point out that the living wage and the London living wage are voluntary rates. An employer can choose to pay those living wage rates to employees aged 18 or over. They are not the same as the national minimum wage and the national living wage. They are statutory, they are mandatory. You have to pay at least the national minimum wage and the national living wage rates per the appropriate age category. Those rates are announced by the government and take effect each April. These living wage rates are voluntary, and they took effect from the 22nd of September, although, like I said, employers have up to 6 months to implement them. And of course, they are higher. So the real living wage rate, if you live in London, is £11.95, and for everybody in the UK out with London, it's £10.90. There's no age brackets or whatever. Everyone over the age of 18, that's the rate that has been set. Do we have any questions about the real living wage? Okay. Holiday pay ruling. It's in a holiday pay training course. It's just one slide in a payroll update session. Many of you who've joined my payroll updates in the past will have heard me banging on about how the rules for calculating holiday entitlement and pay have changed following a court case that was 3 years ago, but people still ignore it. And only last week I was talking to someone from a big educational establishment, and they've flagged up that the process had changed, but they were told, doesn't matter, we're going to carry on doing the way that we've always done it. So, like I said, don't worry, it's only one slide. If you've heard this and you've already implemented the new rules, that's fine. For those of you who haven't heard about it, just go through this one slide. I do accept I'm a bit like a stuck record, and I'm going to carry on saying it until the message finally gets out there. Using 12.07% to calculate holiday pay is unlawful. It's against the law. Why do people carry on flouting the law when they've been told something's unlawful? Maybe it's because employment tribunals do have a habit of overturning earlier judgments. So maybe employers have been operating a wait and see attitude. But in July this year, the Supreme Court ruled in a case of Harper Trust versus Brazil. And that's where it stops. There's no other court after the Supreme Court. That's the highest court. So there's no more courts to turn to. This is the position that we've got. Employers have to accept that they must stop using 12.07% when they're calculating holiday pay. We wouldn't consciously break the law in any other area, so why do we do it now? I guess it's because the alternative's just too hard. So rant over, I'll climb down off my soapbox and I'll explain what I mean. Calculating holiday pay for salaried workers with regular hours is pretty straightforward. Very often there's no change at all to their pay. They just carry on receiving the same amount when they're on holiday as they would have done if they'd not been on holiday. But for workers who work irregular hours or work term time, it can be more tricky, because how do you know what hours they would have worked if they'd have been working? There used to be an accepted formula included in ACAS guidance, which is crucial, really, I think, which said that you use the multiplier 12.07%. For those of you who are in education establishments or local authorities or whatever, you might well be quite familiar with the 12.07%. For everybody else, you'd be thinking, that's a weird number. Where on earth does that come from? And it comes from, it's the percentage that has been used for holiday pay calculations for many casual workers over a number of years. And it was recommended by ACAS as the best method in order to ensure that the 28 days or 5.6 weeks of holiday that we're all entitled to was administered properly. It worked mathematically on the basis that there are 52 weeks in which in the year. If you take from that the 5.6 weeks of holiday that we're all able to have, that leaves 46.4 weeks. So then you divide that into 5.6 and it gives you a percentage of 12.07. So it's a way of working out the percentage of the year that we all work and we all take holiday. So it brings people who don't work for a full year, it gives you a pro rata of how much they've worked against what they would work if they were a full-time worker. The only problem with the logic is that that calculation did not easily fit where the employee only worked part of the year. So if we've got term time workers, for example, hence me talking about educational establishments, but it might well be used in other settings as well. Just have a think back. Does your workplace use 12.07% to calculate holiday? So there was a problem with the using 12.07% in that it didn't always work out as generously as using the formula that is used for everybody else, which is that to calculate holiday pay, you use a 52-week reference period to calculate average weekly pay. So you look back, how much has this person earned over the last 52 weeks, divide it by 52, and it gives you the average week's pay. If there are some weeks where they haven't received pay, then you keep going back. If there's 1 week they've not received pay, then you go back to 53 weeks. And so that you've got the extra week. As far as you can, you get the 52 weeks of pay and then average it out. Would you just be able to turn your camera off? Is that all right?
All right.
Please. Thank you. And mute yourself as well, because we're recording. So Ms. Brazil's position was that this 12.07% calculation left her worse off than she would have been under the working time regulations. The working time regulations state that people who work varied hours holiday pay should be calculated on an average of the previous remuneration. At the time of the original case, it was a 12-week reference period, but now it's a 52-week reference period, but the principle's the same. On the employer side, they argued that the averaging method would give an unfairly generous result for Ms. Brazil when compared with other members of staff. So based on her working hours, using the rules for working time regulations, she was actually receiving 17.5% of her hours as holiday pay, far more than the 12.07 that the guidance originally said. But since July 2019, the guidance to remove 12.07% has been removed. ACAS no longer suggests it because the law requires that workers are entitled to 5.6 weeks holiday pay based on the average week's pay over the course of the year, no matter how few weeks they've actually worked. The principle of applying a pro rata reduction to the accrual of holiday entitlement only applies in respect of the hours worked over a week, not the weeks worked over a year. Does not matter if in some weeks there's little work, as long as there's not been an extended period where no work is applied. So if anyone pays term time workers and uses the 12.07% method, you have to stop and you have to start using the calendar method, or you leave yourself open to being taken to court. Now, I put the guidance link on here because there has been technical guidance with example calculations that have been created. Now, this is long guidance. You need a pot of tea and a packet of hobnobs and a nice quiet Friday afternoon to go through this guidance, but you should be able to fit your circumstances into one of the examples in there. I can see that there are questions, and this is the last slot of the session anyway, so we'll go straight in to the questions for holiday pay, and then we'll look to see if there's any questions about anything else that we've talked about today. So I can see that Glenn has got their hand up. Would you like to ask your question out loud, or would you like to put it in the chat box? Oh, there's a question in the chat box from Glenn that said, how should I calculate 0 hours workers? Well, what you have to do is look at how much they have earned each week over the 52-week period, or keep going back longer. You might have to go back a maximum of up to 2 years, 104 weeks, so that you can find 52 weeks that are paid and divide it by that. And then your problem comes with you're quite right, how you work out what a week's pay. Well, that gives you what a week's pay would be, and then it depends whether they're just taking a day off, if you like, or if they're not working that week and say, I want to take that week's as holiday pay. You would have to look at that guidance that is on the screen there at that link and work your way through there. But I have to tell you now what the government has not done. The department responsible for the guidance is BEIS, the Department for Business, Energy and Industrial Strategy. And what they have done is said to you, you cannot use this. But what they haven't done is said what you can use instead. You have to use the 52-week reference period for working out the pay, working out the hours that you are about to pay. It is slightly different. For someone who works 0 hours, have you offered them particular hours in a week and they can't work that week? Would you constitute that as being a week off? Would you then pay them the whole of the week's rate? There are all sorts of difficulties in there, and I completely accept that, and the guidance does not explain that. But what you can't do is the 12.07%. Have you looked at that guidance? It's a bit, like I said, it's a big technical book, but it does have lots of examples in there. Glenn, have you looked at that guidance? If you look at it, like I say, you do need to spare a couple of hours, and ideally with a nice big pot of tea, because it's not something to go through quickly, but it includes all those scenarios of people with irregular hours, people with they don't work every week. So people with irregular hours, but they work every week, just not the same number of hours, and people who don't work every week. It includes all those scenarios in there. Do we have any other questions? And Glenn, oh right, Glenn said, I'll check the guidance, speak with HR as well. Thank you. You are very welcome. What we are finding, I'll be honest with you, is a bit of different perspectives, shall we say, between sometimes the HR and the payroll department. So if you do have any problems, email me at payrollsupport@mbkbgroup.com. Or there are email addresses on the end for the general MBKB, and they will send them on to me. If you get stuck, and then we can try and work our way through your situation so that we can come to a position where you and HR and everybody else is happy. One thing not to go down the line of is, well, the employer's quite happy with the way we do it, the employee's happy, so we're just going to carry on. It doesn't matter whether the employee and the employer are both happy with the arrangement. If it's against the law, it's against the law, and you're not supposed to do it. What about bank staff who work only on demand? So for this, again, it's very much actually the same kind of situation as Glenn said. If you just bring on people and they don't have a continuous contract throughout the period, then you wouldn't have to go back the 52 weeks. If you've got bank staff who you retain and they're on your, they're classed as your employees for the full 52 weeks, then you would have to go through this process. If you start them and then make them a leaver when they stop each time, well, then you don't have to go through this process. But if you do have them on as a permanent employee and you just bring them on as and when, then you have to do exactly what I've just said to Glenn. Any more questions on that? A new holiday pay would be the one that got you all going. We focused on this. We've completely forgotten about the Chancellor's fiscal event. Can you put them on as a stop? Well, you can, but of course then you would have to make them as a leaver properly. So then you would have to give them the P45, you would have to put them on the FPS as leaving, and that's the only way around this, to be honest. Properly start them and stop them as you're going along. So what you have to work out is which one is more burdensome from an admin point of view. Any more questions about anything we've talked about today? Okie dokie. So, as Claire has already said, we will be putting these slides with the recording on our MBKB website. For those of you who were here at the beginning and experienced the technical difficulties, you will understand that it's going to take our digital expert a little while just to do the editing to cut out the technical glitches in the middle, but they will be on the website, hopefully, fingers crossed, sometime next week. In the meantime, if you do have any more questions, then if you email, like I'd said before, payroll support@mbkbgroup.com, or even if you email train@mbkbgroup.com, the email will bounce its way to me eventually. If there's no other questions, then I thank you for your time. If we do have any significant changes that come out between now and when we've got the next newsletter, then I will let you know. Otherwise, expect your newsletter at the end of October. Okie doke, you have a great rest of your Friday and a good weekend. Take care. Bye-bye.